Hello everyone and welcome to this very short webinar. As you have seen from our recent members alerts and the What's New section on the APLMA website, we have launched our new Term SOFR facility agreement. In our view, this is a very important addition to our documentation library and merits a short one-off webinar to explain what it's about and why we think it's so important. In the interests of keeping the webinar short and to the point, I've decided to talk about the new facility agreement on the basis of what, why, when, who and where, in the hope that this will allow me to hit the main points without boring the pants off everyone tuning in. So let's get started with the what. The new document is a multiple borrower, multiple guarantor, single currency, that's to say US dollar, term facility agreement, which employs CME term SOFR instead of LIBOR as the benchmark for pricing loans drawn under the facility. It's actually based on APLMA's latest LIBOR document, and hence it looks, smells, and tastes like any other APLMA template document. However, to be very clear, the document is not yet in recommended form, because there are still quite a few issues which are raised in the document for which there is no established market practice, and that's why we've called it a discussion document. It also comes with a helpful guidance note which attempts to address some of the open issues and describes options and alternatives which market participants may wish to consider. Both the agreement and the guidance note are now available to members on the APLMA website. Now we get to the why. As I'm sure you all know, the US dollar is the most frequently used currency in the APAC syndicated loan market, accounting for more than 80% of all syndicated loans arranged in the APAC region ex-Japan. As I'm sure you also know, much has been said and debated about using overnight SOFR and calculating interest in arrears, with all the related complexities pertaining to look-back periods, observation shifts, cumulative versus non-cumulative calculations, and so on. There's also been considerable debate about using daily simple SOFR and employing simple averaging, or in fact using historic averages or synthetically created credit-sensitive rates. Term SOFR is a forward-looking rate which can be used and operationalized in much the same way as LIBOR, without having to deal with any of the problems I have just mentioned. In fact, the conventions for term SOFR, in terms of rate setting, day counts, accruals and the like, are all very similar to the conventions we've been using for LIBOR for a very long time. Moreover, CME term SOFR has been endorsed by the New York Fed, the ARC, and the LSTA, and has been signed off as being IOSCO compliant. So from a practical perspective, term SOFR has a lot of appeal. So what about the when? The answers to this question must be blindingly obvious. It must be now. Many of the central banks and regulatory agencies around the world have already issued regulatory guidance saying that there should be no more LIBOR contracts after the end of this year. Whilst there is some flexibility to continue using US dollar LIBOR for some legacy deals, the regulators have all recommended that market participants should adopt risk-free rates, such as SOFR, as soon as possible. So the time is definitely now, because time is running out. This is, of course, one of the reasons why this new document has been so eagerly anticipated and sought after. So this brings us to the who and where. Again, the answer here is very obvious. Lenders, borrowers, intermediaries, including facility agents, secondary traders, and debt funds around APAC should all be looking very carefully at their options, the options that are available to them for replacing LIBOR, and considering whether term SOFR meets their requirements and expectations in the dollar market. This applies to legacy transactions which need to be amended, as well as to the new transactions to be signed after 31st December 2021. It's perhaps worth mentioning at this point that term SOFR has not been so eagerly anticipated in London, the home of the LIBOR rate settings for many years. The Financial Conduct Authority and the Bank of England Working Group continue to endorse compounding in arrears methodologies, and although the LMA has produced a term SOFR exposure draft, the document is described as being targeted at developing markets, and LMA does not, at this stage at least, consider term SOFR to be mainstream and critical to the dollar-denominated syndicated loan market in Europe. Personally, I find this a bit surprising, and while I accept that there are some issues to be resolved, overall I don't think that those issues are insuperable, and I would like, if I may, just to touch on some of those issues very briefly now. The first one is whether or not to include a credit adjustment spread in order to compensate lenders for the economic difference between US dollar LIBOR and term SOFR. This arises due to lender credit risk and duration risk, and applies mostly to amending legacy transactions, but also needs to be considered when originating and documenting new transactions as well. The second issue, and this was the one which caused us the greatest concern at the drafting stage, it's about the waterfall of fallbacks to be used in the event that term SOFR for the relevant tenor is not available. The APLMA term SOFR document currently specifies interpolation of available rates firstly, then falling back to a central bank rate, and then ultimately to lenders' cost of funds. One of the biggest problems here that we found is the fact that the shortest tenor of term SOFR currently available is 1 month, and using overnight SOFR as a temporary fallback could lead to really undesirable consequences, including problems of averaging overnight rates, to say nothing of occasional spikes in overnight rates, which we've actually seen, and the possibility of an inverted yield curve. Next, break costs have always featured in APLMA templates as a means of lender yield protection, but it might be argued that they are now an historic relic of the past, because lenders nowadays rarely match fund their loans to their clients. However, lenders may still consider that they need to be compensated for the administrative burden when dealing, for example, with prepayments, and this can of course be handled in other ways. The last issue that I'm going to mention is market disruption, which, like break costs, is a form of lender protection in the event that the rate of interest, which is fixed for a loan, decouples from the actual cost of funds for the lenders that are making that loan. In the APLMA discussion document, market disruption protections are optional, and market participants will need to decide whether they remain relevant today. There are a number of other optionalities and alternatives described in the footnotes to the discussion document and in the guidance note, which hopefully will assist market practitioners to find a suitable landing on conventions and best practices going forward. So that's about it. A short description of the new APLMA term SOFR document. I hope that you found this webinar to be helpful, and suggest that if you do have any questions, you direct them to us here at the APLMA, addressed to me personally or to the Secretariat at APLMA, I'll say it again, at info@aplma.com. info@aplma.com. Thanks very much for tuning in, and best regards from everyone here at the APLMA. Thank you.